Okay, let's cut right through all the hype. In this explainer, we're going to build a really simple but powerful framework to analyze the financial health of pretty much any crypto project out there, so you can see what actually matters.
This right here, this is the most important thing to get. Seriously, forget the complex tech for just a moment. The number one reason projects die is because their bank account hits zero. It's really that simple and that critical.
And yet, this is where so many people get it wrong. The vast majority of investors are focused on everything else. The story, the roadmap, the hype on social media, while they completely ignore the financial reality that's going to make or break the whole thing.
So let's talk about that million-dollar mistake. What we're going to do is build a kind of financial X-ray, a way to look right past the surface and see the true financial skeleton of any project.
And this X-ray is built on three really simple steps. First, what does the project actually own? Those are its assets. Second, what are its hidden costs? Those are its expenses. And third, when you put those two together, how long can it actually survive? That's its timeline. All right, so let's dive into step one, looking at a project's true bank account. You should think of a project's treasury just like its balance sheet. It tells you exactly what financial firepower it has to build, to grow, and, well, to survive. But you gotta be careful, because the big headline numbers can be incredibly misleading. A project might scream from the rooftops that they have a $100 million treasury, but if 80% of that is in their own super volatile token, it's basically a house of cards. If that token's price gets cut in half, their real treasury just took a massive hit.
So, to measure this risk, we use a simple metric called the stablecoin ratio. It's just the percentage of the treasury that's held in reliable, stable assets like USDC. This one number is your single best indicator of a project's true financial strength.
And here's the cheat sheet. If a project's stablecoin ratio is over 50%, that's a strong sign. Between 30 and 50%, okay, that's moderate risk. But anything below 30%, that project is officially in the danger zone. It's financially fragile.
So that covers what a project owns. Now let's look at what it spends, starting with the hidden cost of free tokens. This is a concept that most investors totally miss. In crypto, just giving out new tokens is a very, very real operating expense. Think about it like this. A normal company pays for salaries, rent, and marketing with cash, right? Well, a crypto project often pays for the same things: development, security, growth, by just printing new tokens and handing them out to the team, to VCs, and to validators. That token inflation, that's a direct cost. And why is it a cost? Well, because these emissions create this constant, silent pressure on the token's price. When people get paid in these tokens, a lot of them need to sell them for actual dollars to pay their bills. And all that selling pushes the price down over time. I mean, look at this. The incentive here is crystal clear. If an early VC got in at 2 cents and the token is now trading at $1, that's a 50x return. It's not a question of if they're going to sell when their tokens unlock, but when. It's just rational financial behavior. Okay, now for the most important part, how to calculate survival time. We've looked at the assets, we've looked at the expenses, now we're going to put them together to find what is probably the single most important number for any project, its runway. First, we need the top number in our equation, the project's stable treasury. Remember, this isn't the big flashy number. It's the real cash they have on hand. Let's ignore their volatile native tokens and say this project has $24 million in stable assets. Next, we need the bottom number of our equation, the monthly burn. This is just how much cash the project burns through every single month on salaries, marketing, all that operational stuff. For our example, let's say it's $1 million a month.
And now, the formula that puts it all together. A project's runway, measured in months, is simply its stable treasury divided by its monthly burn. This is honestly one of the most powerful calculations you can do in crypto finance.
So let's do the math. $24 million divided by a $1 million monthly burn gives us a runway of 24 months. Now that is a powerful sign of health. It means the team can just keep building for 2 full years without making a single dollar of new income.
Now, 24 months is great. Anything below 18 months, though, that's a major red flag. Especially in a bear market, a short runway puts the team under massive pressure, and it can force them to make really desperate moves just to stay alive. Okay, let's pull all of this together into our final actionable section, your red flag checklist. These are 4 super simple checks you can run on any project to immediately get a sense of its financial risk.
Here they are. 1.
Is the Treasury dangerously concentrated in its own token? 2. Is that stablecoin ratio down in the sub 30% danger zone? 3. Is the project just printing tokens to survive, with no real business model? And 4. Are massive amounts of tokens about to unlock for early insiders? If you can check 2 or more of these boxes, you need to be extremely cautious.
And that brings us to the final critical question you should really ask yourself before you invest in anything. If you can't clearly explain where the money's coming from, where it's going, and how long the project can actually survive, should you really be putting your own money on the line?